Welcome to Framework Fortune, and welcome back to all you extravagant individuals in the Framework Fortune community. I'm your host Ben, and we're going to jump into a day trading topic and just a trading topic overall that I feel like I haven't covered that much, and that is the setups that usually provide the best opportunities for consistency. So we're not going to waste any time. We're going to get right into it. So this chart is Chemical Corporation. This is a possible uranium play. At the moment, it has been uptrending since 2020, the beginning of the year after the COVID dip, and still is holding up very strong around this $25 area. Now, as a long-term trade, where would have been the best entries to get into this? Because that's what we're talking about when we're talking about a setup. We want to find the best entry and have the best exit. And in that setup, we want to have a very high reward with a very low risk. And that's called your risk to reward ratio. Just looking at a daily chart of 1 year, basically, a year and a half we'll say, but 1 year basically, of CCJ, where would have been the best places to try to catch this as a setup? Well, obviously, if this thing was riding along and starting to build up in 2019, and then we come into 2020, have that sharp COVID dip, this thing went all the way down to $5. You can see all the way back to 2015, that was not a normal price drop for it to hit that type of low. So this was a good setup when it started rebounding and the overall market started rebounding because you're getting it for a way cheaper price. Now, just because a stock is a cheaper price, just because it's way down in price, does not necessarily mean that it's a good setup. You can buy something that is really low, that's been previously really high in the past, and it may never return to those highs and could continue to sell off. So this is a strong company. If we was to look at their financials, this is clearly not a penny stock. This is a actual good company. So getting them at a way cheaper value is a good setup. But let's say we missed that first initial dip there in COVID, and we see it's building up here, and we're like, man, we want to get in this because it looks great. Well, if you got in anywhere up here, you might have made some nice quick little profits, maybe scalping intraday or whatnot, but it had a nice pullback. And when it had this pullback, you wouldn't have been able to get all the way at $5, but as it held up these EMAs, the 50 and the 200, and started forming this trend line, well, that's a pretty nice looking setup, because then when we scroll back, we can see, oh, this thing was low for 2018, and because it rebounded so hard back here and finally broke over these previous peaks, this peak, this peak, this peak, that's all resistance, it was able to start climbing back up and even break over this previous peak at 25, which is what it's holding now. That would have been a good spot to look at. Now, once it starts ripping again, you don't really want to be getting in here at the tops. It's never a good idea to get in at the tops unless you're short, because then if you're short and you're in at the top, more than likely it goes down, right? But if you're a long bias trader, you never want to be getting in at the top. You want to be planning your entries for somewhere on support lines. And with longer term trading and swing trading, you have plenty of time to chart all of this out and look back and find those points of support and resistance where you can get those entries. Now, and if we're looking at risk to reward ratio, say we were planning on trading this after the COVID dip and we got in right here, right? So what is our risk? Well, if we got in, let's say about $10 here, and the trend line of support is around $9.50, this little bottom here, then that would be 50 cents if we put our stop loss below that $9.50 area. that we would be risking, with a possible upside, at least to this previous peak of $13. It would be $3 in profit if you held it up to this previous resistance line. So your risk would be 50 cents, your reward would be $3. That is a low risk, high reward setup. That is a 6-to-1 ratio, because $3 is 6 times more than the 50 cents that you're risking. Those are the type of setups I look for no matter what type of trading I am doing. Now, if you're looking at it right now and you see it up here at this top and it's coming down the support line, you're thinking maybe 25 holds it with support and all that back there. Well, it could, but now you're getting a little bit riskier, and this setup is not as good. It is still building the higher lows and the higher highs, but it may be getting too extended. And basically what that means, it's been running either in an uptrend or a downtrend for quite a long time and starting to run into a lot of selling pressure in these previous resistance areas. So if you get in here, even at 25, you could risk the trend line, which is where you'd have your stop loss, and maybe it's the same type of 6-to-1 ratio if it can have another push up right away. But if it cracks this, you're way up here when you could easily drop way down here. Now right back here where we could have got in at, the distance to that low was only that. The distance to that low from here is this whole space. So an entry here, an entry here is a lot less risk just overall than it is way up here. But like I said, not every stock is the same. This is Tops Ships, TOPS, and they are a shipping company. They've been around for a little while. You can see that their chart is insane. And looking at this chart, you're probably like, what? This thing was $5 million a share? No, that's not the case. That's not what happened. They have done multiple offerings, putting out more shares into the marketplace, adding more shares to the supply, which continues to decrease the value of the shares because they continue to put out more shares than they have people willing to buy it. And they do this to stay listed on the NASDAQ. If not, they would fall into the OTC markets, which is not where they want to be. But if you was to look at this and didn't realize that common share offerings and dilution and all of that was a part of stock market, then you might think, man, this thing is a great buy down here at 90 cents when it was all the way up there at 5 million or whatever. So this would not be a good setup, even though you're all the way down here at this bottom and there's a possible even double bottom if it doesn't crack through 70 cents. This thing could easily continue to go down. And if they do another common offering or something like that to add to the supply to stay on the NASDAQ, you will probably get destroyed if you're holding this play long term, just because of the fact that if you would have bought it at wherever they started the common offerings, it has continued to go down, so you just have a whole lot more shares that are worth a whole lot less, and that will probably be the continuation of this company until something happens and they turn it around. But Top Ships is one I see a lot of people talk about in a lot of different groups and all of that, but this is not a good setup. IMTE is a swing trade that I'm currently in. This is a NFT play. You can see it's had some big spikes, but consistently it has stayed in this general price range between $4 and $10 since it's been on the market. It's had some spikes up, did have a little dip down, but even with that little dip, it has had buying pushing it back up, and we have a slight uptrend. So seeing that's been building up on this nice uptrend, and then it had a nice explosion starting at the beginning of the year all the way into the end of March, where it was all the way up at $40. Well, it gave back all of those gains and is now right back here on this trend line at $4. So if it holds this trend line, and we can easily see some type of bounce back up to the top here of this channel. If it was to crack here, it could get pretty ugly. But the distance from my entry to the bottom of the peak right here is not that far compared to if I was someone who would have got in, way up here at the top. That distance is a whole lot longer of a distance than where my entry is at. So it may not return to $40, but if it returns to the top of that channel at $10, and I'm only risking $4 down to say $3, then I'm risking $1 for a possible $6 run. So $6 in possible profit, risking $1. That's another 6-to-1 ratio. And these setups and ratios, even if they're the best setups in the world, they're not always going to work. Nothing ever works 100% of the time in the stock market or in any markets. But consistency is the main key, and knowing how to recognize good low risk, high reward setups will help you tremendously in your trading. Now, what about for day trading? Well, there's really no difference in day trading, swing trading, and long-term trading other than the amount of time that you're willing to hold that position. So with a day trade, you're just looking at the shorter time frame, and you still want to see a good risk to reward ratio. So this is Forge on a 15-minute chart today. Now, Forge ran from about $16 up to $20, so ran about $4. Now, looking at this 15-minute chart, if you got in way up here, well, where did this start out in the morning? It started out down here, actually, with a little gap down at $15. So if you got in way up here at the top, your distance down to that previous support area is quite a ways down, whereas you start to see a little uptrend forming right here out of pre-market, and you decide to get in, say, right here once it starts showing some buying volume coming in. Well, your distance to that pre-market little low there is only that. So if you get in here at 1660 and you know the low is 1530, maybe you think that 1550, that's about $1 just for rough number estimates that you would be risking. And if you hold and sold at the top at 20, then you would have got $4 in profit. So another way to look at your ratio is basically the distance from the beginning support of the day or over a longer time frame if you're looking at longer trades. But even looking at that support today, what I always say, look back on the past chart. That is all types of data that you can look at that will help you. Well, if we look back just a few days, we can see that same $15 area straight across there. There was a bunch of support, and the EMAs were right there as well. And then it was resistance back here on this peak. So by just looking at a few days of the past chart history, we're able to see that this is probably not that bad of an entry, especially now that we've pulled back. It's pretty clear this entry here, that ideal entry, is actually on a longer time period over a couple of days, an uptrend. So you would have been buying at multiple levels of support and the uptrend for that low risk with that possible high reward. Now, the last part of this topic I want to cover is your share size. So your share size is going to be important to your risk to reward ratio, because depending on how much the price moves and depending on what the price is and depending on how much money you have to work with will depend on where you want to set your risk and reward at. So I'm going to use NVIDIA for this example because this is a lot higher price stock. So looking at NVIDIA, clearly over the past couple of weeks or whatever, we can see there is an uptrend that was going, and then that uptrend cracked here today. So again, if you got in back here, there's that original dip, or back here, both of these areas are not that far off of the trend line where each one of these dips is starting to get bigger and bigger until this final one here, where we're really far off the trend line. And that's usually when you see those cracks. But let's say you had $400 in your account and you're trying to day trade NVIDIA. And let's say you saw this whole move up to here and then this pullback and it holding above that trend line. So you wanted to get in today right here for this break of that 200-day, this little U shape also there coming into market open. And you get in 2 shares for about $400. Well, this gets a rip up from 194 to 200. That is $6 a share, and you may only be risking $1, so it could be a 6-to-1 ratio. But because you have only 2 shares, it's only going to be a profit of $12 versus Forge, where if you got in here with that same $400, you would be able to afford close to about 25 shares off the top of my head. On 25 shares, if you get that $4 run, well, that's now $100. So instead of using your $400 to trade a lot higher price stock, even with the same risk reward ratio, you're getting more bang for your buck with the lower price. You don't have quite as much capital, especially if you're a new trader. So the setup I'm looking for is the one where I'm getting the biggest bang for my buck in the price range with those low floats, because the lower the supply, higher demand, the bigger the rips they can get. So the setup's being the same no matter the price range of the stock. It gives you that flexibility to move down to a lower price for certain plays that you may be looking for when you see a nice setup that gets you more profits for the bang for your buck. Hope that gives some clarity on some risk to reward and the trades I look for, especially during the live streams. If you haven't yet, also go hit up HHTRADER's channel as he is covering uranium stocks. It seems to be some interesting things happening in the uranium market. Appreciate everybody joining me as always. Stay safe out there. Till next time.
This is war with the enemy. Think that it was meant to be. Living in a time where disease is on every screen. I won't let them fester me. I know most are festering. Negativity is a plague for the mentally